welcome everyone to today's IAA briefing on the 2022 SEC exam priorities and related regulatory initiatives. We're approaching this briefing a little bit differently this year since the SEC, under the leadership of Chair Gary Gensler, is pursuing an enormously ambitious rulemaking agenda, and there's significant synergy between the exam priorities and what we're seeing on the rulemaking front. Put another way, the rulemaking agenda is largely following concerns that have been raised in exams over the past several years, while the exam priorities are also reflecting the areas that this chair has indicated are of particular importance to him. Suffice it to say that we're seeing some significant shifts in the regulatory landscape for advisors, and these changes are reflected in this year's exam priorities as well. So today, we're not only going to focus on the exam priorities, but we're also going to talk about the interplay of those priorities with potential changes to advisor regulation. After providing an overview of 2022 priorities, we'll discuss significant examination focus areas, including private fund advisors, cybersecurity, emerging technology and digital assets, and of course, ESG, environmental, social, and governance. The team will try its best to answer your questions, but if we don't get to them all, please remember that you can always contact the legal team. Our email address will be at the end of the slide deck. Slide 3, please, Lisa. With that, I'd like to turn the discussion over to members of the IAA Legal Team. Sanjay Lamba, IAA Associate General Counsel, will be moderating today's conversation with Associate General Counsels Monique Botkin, Laura Grossman, and William Nelson. They have a lot of ground to cover, so without further ado, I'll turn it over to Sanjay.
Okay, great. Thank you, Gail. So before we dive into the SEC's 2022 examination priorities, let's talk about some of the interesting statistics that they published as well. I think it's always kind of interesting to see where they are in terms of exam coverage. So as you can see from this slide, the SEC exam staff conducted a total of a little over 3,000 examinations. Now, this is a 3% increase from what they did in 2020. And as they noted in their priorities, it's on par with the numbers that they were having before the pandemic in 2019. In terms of their operational status, we understand that the exam staff is still doing exams remotely. They're not coming on site unless there's a urgent need to. But we've also noted, and this has been a trend that's taken place in recent years, that they're doing a lot more informal outreach. So for example, don't be surprised if they just sort of call you out of the blue and just sort of ask you some questions. This is a practice that they've been doing more of. Last year, in 2021, they issued over 2,100 deficiency letters. They made more than 190 enforcement referrals. This doesn't mean that they were necessarily accepted. In fact, I think the majority of them, the vast majority, are not accepted by enforcement, but nonetheless, there were 190 enforcement referrals. And as you can see from this pie chart that we included, the vast majority of exams that they conduct now are of investment advisors. So they conducted over 2,200 examinations of investment advisors. That equates to about a 16% coverage, which is slightly above actually what they've been doing in recent years, which is 15%. They conducted 125 exams of fund complexes. Funds and ETFs has been a priority for the exam program for years now, and we'll talk a little bit about some of the initiatives there. They also issued 9 risk alerts, and we expect this trend to continue. And I think from our perspective, and I'm sure from yours, they are helpful in sort of giving you some insight on some of the areas that the exam staff is focused on. And we'll talk about some of the risk alerts today as well. Next slide, Lisa. So as Gail mentioned, I'm going to start off by just providing a brief overview of the examination priorities. They were published at the end of March, which is actually on the same time frame as they were published last year. I guess we have noticed that they've been getting sort of pushed further and further into the year. But I think it's fair to say, as Gail noted, that this year's exam priorities really do reflect the regulatory initiatives of Chair Gensler when he came into office. So I think it's fair to say that the exam priorities took a little bit longer, likely because of the input that was provided there. Next slide. Okay, so we'll certainly talk about some of the specific focus areas, but I do think it's mentioning that on any typical examination, the SEC staff will always look at your marketing materials. They'll look at your custody provisions. They'll look at valuation, portfolio management, including your best execution practices, and of course, they'll always look at conflicts of interest and related disclosures. So you can expect this to sort of continue. Now, with respect to marketing, obviously we have the new rule that's coming into effect in November. So I do suspect as part of the exams, they'll start to kick the tires on that. I don't think the exam staff will be completely sort of ramping up their examinations in that area. I would expect them to really focus on the new marketing rule under next year's priorities. But nonetheless, they will be looking at your marketing materials like they always do. Next slide, Lisa. So now in terms of advisor examination areas, as you can see from this slide, they'll be checking to make sure that that your best interest obligations of the fiduciary duty has been met. This means that that any investment advice that's provided is in each client's best interest. They'll also be looking at the oversight of service providers to make sure that the oversight is adequate. One area that they will always look at is how much resources are devoted to your compliance function. This really goes to sort of assessing the culture of compliance, is how the SEC staff likes to put it, as well as sort of the management buy-in as to how important compliance is. So you can expect at the outset of every exam, examiners will be trying to get a sense of your compliance culture, and resources is a good way to sort of determine that. Firms that are using alternative data or data from non-traditional sources as part of your investment decision-making process, examiners will be looking to confirm that you are implementing appropriate compliance and controls around non-material, non-public information. Examiners will also be looking at to make sure that you have heightened oversight of employees that have a history of disciplinary actions. If you have branch offices, they will be making sure that there is adequate supervision of those branch offices. And as really as always, they'll be looking at your management fee calculations to make sure they're consistent with what's in the actual management agreement. They'll be looking for inaccurate calculations of tiered fees. So, for example, breakpoints and aggregate household accounts. And they'll also be making sure that they'll be looking to see if for terminated accounts that the fees, any prepaid fees were refunded, and also prorated fees for onboarding clients. They'll double check your calculations on that front. Next slide. So I want to turn it over to Monique now to talk about the priorities with respect to mutual funds and ETFs.
Thanks, Sanjay. So as Sanjay mentioned, the SEC will continue to prioritize exams of registered investment companies, given their importance to retail investors, issuers, and the market. The SEC will examine for tailored and updated mutual fund compliance programs that address business practices, including portfolio management, valuation, trading, conflicts of interest, fees and expenses, and advertising. The focus also includes disclosure and compliance with exemptive orders. This year, the SEC highlights compliance with the liquidity risk management rule, including appropriate oversight of third-party vendors that provide liquidity classifications of portfolio investments, applying the 15% illiquid investment limit, and required record keeping. The SEC will also examine for oversight of the viability of smaller or thinly traded ETFs and oversight of their liquidations and communications with shareholders. Two types of funds are highlighted also, money market funds and business development companies. The focus on the money market fund rules stress testing is aligned with the SEC's current proposal to amend the rules provisions around liquidity and pricing to bolster the resiliency of the funds in stress events. And with the growth of BDCs and their availability to retail investors, the SEC includes them in this year's exam priorities. They'll be examined for compliance with valuation practices with illiquid securities, marketing rules, and overseeing and managing conflicts of interest with underlying portfolio investments. And the last point I'll mention here on mutual funds relates to private funds, a topic we'll discuss later in the webinar. With regard to the growth in alternative investment opportunities for retail investors, the SEC is prioritizing exams of mutual funds investing in private funds, and the focus here is on mutual fund risk disclosure and valuation practices. Next slide. Sanjay, back to you.
Great, thank you, Monique. So, I think certainly one trend that's been obvious in recent years is that the SEC staff is really focused on making sure that advisors are adhering to their fiduciary duty. Of course, the commission put out an interpretation on the fiduciary duty a few years ago, and this has been a heightened focus. So next slide, Lisa. So with respect to fiduciary duties, the staff will look into making sure that advisors are acting consistent with your fiduciary obligations, particularly your duties of care and loyalty. This includes best execution obligations, and of course, always financial conflicts of interest and making sure you have related disclosures. Now, with respect to specific focus areas that were laid out in the priorities, the staff will continue to look at revenue sharing arrangements. Share class selection continues to be a focus area of the SEC staff. So, for example, they'll be looking in situations where the advisor may be recommending no transaction fee mutual fund share classes that have 12b1 fees and wrap accounts, where the advisor may be responsible for paying transaction fees. They'll also be looking at situations where advisors are recommending wrap fee accounts without assessing best interest obligations. And the focus here has been on the recent move and the impact of moving to zero commissions on certain transactions that certain broker-dealers have announced. They'll be looking at situations where advisors are recommending proprietary products that are resulting in higher or additional fees. So the fiduciary duty will be, a sort of a main priority here. So the next slide. Now, so Form CRS was obviously a new document, a new disclosure document that many of you have had to work on in recent years. And unfortunately, we're not quite done yet with Form CRS. The SEC staff has been publishing some guidance and some FAQs, as well as some of their observations on Form CRS filings. So for example, in December of 2021, the staff issued a statement about some of their observations. It's quite a detailed statement. So if you haven't looked at it yet, I would highly encourage you to take a look at that statement, take a look at your current filed Form CRS, and make sure it's consistent with some of the expectations that were laid out in that statement. Just a reminder, it's Form CRS is not an annual filing obligation. You only really have to make changes when you have material changes that need to be made. But I would encourage you to take a look at your Form CRS, and if you need to make any updated filings in light of the staff statements, I would highly consider it. This is low-hanging fruit for the SEC, and they will be looking at disclosures. Now, one issue that always that's sort of been there from the beginning, and unfortunately has come up again, is whether or not advisors can use the terms fiduciary or fiduciary duty in Form CRS. And the staff did issue an FAQ on this. Next slide. So in that FAQ, the staff said, yes, you can use these terms, but, and it is a big but, they remind you that there are certain guide rails in Form CRS. So for example, Form CRS is intended to be a disclosure document, not a marketing document. So they're going to make sure that any use of the word fiduciary doesn't run contrary to that stated purpose. You also have to use the prescribed language that's in the Form CRS with respect to your standard of conduct. It's boilerplate language, it's in the form, and the exam staff has noted situations where advisors have altered that language, for example, by adding the word fiduciary, and that's not permitted under the form instructions. Now, the FAQ also cautions advisors against using extraneous or unresponsive disclosures. So you really need to make sure that any disclosures that you provide in your Form CRS, including that use the word fiduciary, are in fact responding to what's required in Form CRS, the items that are laid out there. You can't have any exaggerated or unsubstantiated claims. You can't claim that the fiduciary duty is a higher standard than, say, the duty that broker-dealers are subject to. And you cannot also put in there that the fiduciary duty alone mitigates or eliminates conflicts of interest. Now, I think if you're using the word fiduciary in your Form CRS, I would really take a look at it and how it's being used and make sure it's consistent with these guardrails. Unfortunately, the way the FAQ is worded, it seems to be really sort of biased against using the word fiduciary, but I do want to emphasize advisors have a fiduciary duty. That is your standard of conduct. That is a factual statement. So, we put this quote here in terms of the staff's, sort of claiming that the fiduciary duty may be sort of embellishing factual statements. You are an investment advisor. You are subject to the fiduciary duty. And so if you can find a way to use it in your Form CRS that's consistent with these guardrails, and as long as you're being clear in terms of how you're describing the fiduciary duty, and I would look at the interpretation for that, that should be okay. But I will say though, again, I do think it's going to be a high risk area. If you are using the word fiduciary, the staff will be looking at it, and unfortunately, I think it's going to be really hard to find a way to use it consistent with these guardrails. But that is the FAQ. Next slide. Okay, so now we're going to really focus in on the significant focus areas that the staff outlined. I guess before I move on, I do want to note that the order that the priorities are placed in the exam published priorities does matter. And that is sort of the priority in terms of how the exam staff looks at it. So in this year's priorities, private funds were front and center. And so obviously, if you are an advisor to a private fund, this will be a significant focus area for the exam staff. ESG came in second. The fiduciary duty and Form CRS, which I just talked about, came in third. And then issues relating to information security and operational resiliency, including cybersecurity, came in next. And last is cryptocurrency or crypto assets. Now you'll know that in our webinar, in our presentation today, we're going to use a slightly different order. We just thought it made sense for us to sort of present it in this manner. So, but I did want to highlight that if you look at these priorities, the order does matter. Next slide. So, Gail alluded to this, that Chair Gensler is really focused in on these issues. These quotes are from testimony that he gave before Congress. And so you can see that these are certainly areas that Chair Gensler is interested in. Next slide. And he's followed through on that. There have been a lot of recent rulemakings relating to advisors recently, including with respect to private funds and also amendments to Form PF, which had some proposals that came out. We've also seen proposals relating to cybersecurity that were published on February 9th. And we are expecting, we've seen ESG proposals for issuers, but we are expecting ESG rulemakings relating to advisors sort of coming up next. And William will talk a little bit about that as well. Next slide. So at this point, I am going to turn it over to Monique to talk about the private fund initiatives. Monique?
Great, thanks. So next slide, please. So we have a total of 10 items on the next few slides. It is a lot to cover, but it's important, especially as Sanjay mentioned, because the SEC has put private funds front and center. It's not surprising given what we know about the rulemaking priorities, the private funds unit in the exam division, the recent risk alerts on private fund advisors, and the fact that state and municipal, governmental, and other pension plans are some of the largest groups of investors in private funds. First, the SEC will focus on the fiduciary obligations to act in their clients' best interest. The disclosure of conflicts of interest remains a top exam focus for private fund advisors. This includes ensuring full and fair disclosure of conflicts around allocation of investments, multiple clients investing in the same portfolio company, financial relationships between investors and the advisor, side-by-side investing, pre-existing ownership interests held by employees in recommended investments, and the use of portfolio companies, use of affiliated service providers by portfolio companies. Next is the examiner's continued focus on fee and expense calculation and allocation as it relates to fees after an initial investment, as well as failing to follow valuation processes and disclosures, both of which can lead to overvalued holdings and overcharging management fees. And here the SEC is examining for inaccurately allocated fees and expenses, including broken deal, due diligence, annual meeting, consultants and insurance costs among the advisor and its clients, or other employee funds or co-investment vehicles, where disclosures are inconsistent with policies and procedures, and which cause certain investors to overpay expenses. The SEC is also focused on advisors charging fees and expenses not permitted by fund documents, such as related to salaries of the advisor personnel, compliance and regulatory filings, and office expenses. And all of this can cause investors to overpay expenses as well. In the SEC's private fund advisor proposal issued in February that Sanjay mentioned, the SEC is trying to address some of these concerns by prohibiting certain fee practices, such as charging for advisor compliance or registration, or charging fees on a non-pro rata basis. The last topic on this slide is compliance with the custody rule, including around the surprise exam and updating Form ADV as it relates to the fund's audit and auditors. And interestingly, the SEC's private fund advisor proposal would require private fund advisors to audit their funds annually. And therefore, private funds would effectively not be permitted to rely on the surprise exam option under the custody rule. Next slide, please. The fourth area we've highlighted is preferential treatment in funds with liquidity issues. So examiners here will be looking for robust disclosure of practices and conflicts of interest where certain investors may have been granted terms to redeem under certain circumstances, and they're not aware of other investors' opportunities, and therefore some investors get harmed by that operation of that term. Another practice would be prohibited under the private fund proposal. Private fund advisors would not be able to provide preferential treatment for certain redemption rights or information rights. And in the meantime, the SEC will be scrutinizing this practice before the rule is adopted, if it is adopted as proposed. The SEC continues to focus on conflicts related to cross transactions, and fund advisors here must make sure they're disclosing conflicts related to purchases and sales between clients, especially if the advisor establishes a price at which securities would be transferred between client accounts in a way that disadvantages one over the other. And the SEC will find deficiencies if there's not appropriate disclosure there. Another focus at the SEC is advisor-led secondary transactions. And this is where the advisor arranges the sale of a fund or portfolio to a purchaser. And the purchaser offers the existing investors the option to sell their interests in a new restructured fund. The SEC is also focused on stapled secondary transactions, which combines the purchase of a private fund portfolio with an agreement by the purchaser to commit capital to the advisor's future fund. So here the focus is on undisclosed conflicts of interest around the purchasing fund interest from investors at discounts without adequate disclosure around the value of those interests and the investor's options. The SEC has proposed new Form PF amendments that would require confidential reporting to the SEC of these transactions within 1 business day. And in the private fund advisor proposal, a new rule would require a fairness opinion from an independent third party for these transactions. As noted in the 2020 Private Funds Risk Alert and the recently issued Risk Alert on preventing misuse of MNPI that Sanjay mentioned earlier, you make sure you have adopted and implemented robust policies and procedures around the use of alternative data providers or expert networks, and as well as MNPI risks of investors that are value add or likely to have MNPI, such as employees at public companies. Next slide. We've covered much of the first point on this slide already relating to identifying and managing conflicts of interest and ensuring full and fair disclosure. The SEC has also included for the first time as an exam priority private funds investing in special purpose acquisition companies, especially where the private fund advisor is also the sponsor. So firms here should focus on conflicts of interest and disclosure of relationships and financial incentives of the sponsor, as well as the misuse of MNPI regarding potential SPAC acquisition targets. Firms in this area should consider the impact of the SEC's recently proposed rules for SPACs relating to disclosure and marketing, as well as gatekeeper and issuer obligations, and a related safe harbor from the Investment Company Act. And lastly, here on private funds with an indicia of systemic importance, such as through outsized counterparty exposure or gross notional exposure in derivatives positions, are a new focus this year. The SEC and other federal regulators are revisiting how and when hedge funds can present financial stability risks. And so the SEC will focus on hedge fund policies and procedures on risk management and trading. And as noted earlier, the SEC did propose amendments to Form PF that would require large hedge funds to report to the SEC within 1 business day certain events that the SEC believes would be relevant to distress or market instability. For example, if the fund had extraordinary losses, counterparty defaults, or liquidity events. So at the IAA, we focused on these proposals for our members, worked to put together comments on the Form PF proposal that the SEC is considering. We recently submitted comments on the private fund advisors proposal. So on to the next slide. We have listed here some of our comments. Turning to this proposal, it does relate, as mentioned, to all the cited deficiencies in the risk alerts that you've been seeing over the last 2 years, as well as enforcement actions that the SEC has been bringing. And in discussing the rules, I think it's important for folks to think about what the SEC's view is here. You know, their view is that despite their examination and enforcement efforts, these activities of overcharging funds and investors and undisclosed conflicts of interest persist. The SEC in its proposal here cited a lack of transparency in fees and expenses, the presence of conflicts of interest that are not transparent or are contrary to the public interest and cannot be managed because of the lack of governance in private funds. So this is a significant shift in the thinking and application of the Advisors Act to advisors. Rather than enforcing the fiduciary duty in a principles-based manner, the SEC has proposed to prohibit outright practices, that a private fund advisor can engage in. So we urge the SEC to reconsider its approach, banning certain practices, instead providing a flexible principles-based regime focused on the fiduciary duty under the Advisors Act. The SEC actually already has regulatory tools it needs to address the concerning practices. We also ask the SEC not to unnecessarily prohibit certain activities, like banning limitation of liability clauses or indemnification clauses, reducing the amount of an advisor's clawback by the amount of certain taxes, non-pro rata allocations, and bans on preferential treatment. All of these concerning practices can be addressed through disclosure and consent of the practice. For the quarterly fee and performance statement proposal, we asked the SEC to simplify and tailor that and to allow firms to use their Form PF performance reporting methodology for net and gross performance. We also asked the SEC to eliminate the liquid and illiquid fund categories that private fund advisors would have to assign to each private fund, and to extend the time to permit the distribution to investors from 45 days to 60 days. For the private fund audit requirement, we recommended that the SEC not effectively amend the custody rule without proper notice and comment. But if it went ahead with the private fund audit requirement, to provide certain exemptions for end-of-life funds, smaller funds, and those owned by a single investor. For the advisor-led secondary transactions, we recommend that the SEC permit independent third-party valuations rather than require a fairness opinion. And another aspect of the proposal includes annual reviews. The SEC would require all advisors to document the annual review of their compliance policies and procedures in writing. And we support this proposed change, as many firms already do so, as a best practice. And that will, enhance the examination ability to oversee investment advisors.
Thanks, Monica. Laura, Lisa, if you could just go on to the next slide. I think we didn't do that. No, slide before that. Okay, great. Okay, so Monique, certainly there's a big focus on private funds. You talked about some of the proposed prohibited practices. Certainly that would be an area of focus for examiners. So what would be your sort of takeaway from the exam priorities and some of the areas they focused on in these rulemakings? What should private fund advisors really be thinking about with respect to their compliance programs?
Well, certainly thinking about the framing of the proposal, the way the SEC prohibited practices would be a concern for many all private fund advisors. But just to reflect a bit on the outcome of the potential rule, we do expect the SEC to adopt a package of rules here for private fund advisors, requiring more transparency, and possibly by early next year. We're hopeful that the SEC will move away from the prescriptive prohibitions, which would be a sea change in the advisor regulation, away from the principles-based approach of enforcing the fiduciary duty, which was clarified as recently by the SEC as in the 2019 interpretation. We also expect the SEC to adopt amendments to Form PF that will require more frequent and detailed reporting for private fund advisors. So that's certainly something to keep an eye out. Hopefully they will take our comments under consideration and extend the reporting requirement from 24 hours to a more reasonable time period. So given the exam focus, rulemaking and enforcement focus on private funds, firms should continue to tailor their compliance programs to their business and incorporate the SEC's risk alert guidance and exam priorities guidance in their program, adopting robust policies and procedures, documenting decision-making processes, testing for compliance with policies and procedures, and thinking about how these rules may affect your business and compliance program. And there are two areas in that proposal that you may want to think about now. One is revisiting your use of hedge clauses, if they are in your contracts, considering standards of liability and indemnification in light of the 2022 risk alert, where the SEC staff said that the use of misleading hedge clauses could violate the Advisors Act, and then the SEC's outright ban on certain provisions in advisory contracts. This would be especially true for those with retail clients. And then the second area would be just making sure you're documenting, mapping, and disclosing your agreed upon fees and expenses to your firm's process and related disclosures.
Thank you, Monica. I thought it was interesting that they also proposed these annual review documentation requirements that would apply to all advisors, not just to private fund advisors. Thanks, Monique. So let's move on. Next slide, please, Lisa. So let's talk about operational resiliency and information security, which I think is all related to cybersecurity. So Laura, I'm going to turn it over to you.
Great, thank you. So next slide. A continuing theme that first appeared in last year's exam priorities is information security and operational resiliency. That's a fancy name, but it has to do with cybersecurity, business continuity planning, and data privacy. The SEC makes the point that protecting data such as client information, records, and assets is critical not only to individual advisory firms, but also to the markets more broadly. So what types of security controls will examiners look for? Specifically, they will look at whether advisors have taken appropriate measures to safeguard client accounts and prevent account intrusions, including verifying an investor's identity to prevent unauthorized account access. Next slide, please. Oversee vendors and service providers, and address malicious email activities such as phishing or account intrusions. Next slide. And one more slide. Examiners will also look at how you respond to cyber incidents, including any ransomware attacks, how you identify and detect red flags related to identity theft, and how you manage operational risk in a remote work environment. They will also focus on compliance with Regulation SP, dealing with privacy and protection of client data and information, and Regulation SID to detect, prevent, and mitigate identity theft. Next slide. You can expect examiners to review advisors' business continuity and disaster recovery plans, considering the impact of climate risk and other substantial disruptions to your normal business operations. They will also focus on the maturation and improvements to business continuity and disaster recovery plans over the years, as well as advisors' resiliency to prepare for and respond to both sudden disruptions as well as incremental changes stemming from climate-related situations. Next slide. So earlier this year, the SEC proposed cybersecurity rules for investment advisors, which the IAA submitted extensive comments on. To share some highlights of our comments, we, of course, share the SEC's concerns about the ever-increasing threats presented by cyber attacks, but we are concerned about the proposal's costs and burdens that it would impose on advisors. We made the point that reporting requirements should not be duplicative or inconsistent with other notification requirements, such as the states. We recommend that the SEC coordinate with other federal regulators to adopt a uniform risk-based federal requirement for reporting incidents to streamline the process for advisors. We said that we support enhancing the preparedness and resiliency of advisors and protecting investors against cyber threats. Advisors are already required to have cybersecurity policies and procedures. So as a whole, we support the proposal, but we did offer many recommendations to improve it, such as pointing out that the requirement to have a written contract relating to cybersecurity controls of third-party service providers is not feasible. Next slide. The proposal would require advisors to report significant cybersecurity incidents to the SEC within 48 hours. We are very concerned that that would hamper advisors' ability to respond to cybersecurity threats in real time. We recommend providing more time and using a layered reporting process at a higher level instead. The SEC also proposed extensive disclosure requirements. We recommend changes to permit advisors to provide a more concise discussion of cyber risks and incidents in their brochures, which of course are public documents. Finally, we request a compliance period of at least 18 months. Sanjay, back to you.
Yeah, Laura, this is a, you can go back to the previous slide, Lisa, this is a significant, I think, rulemaking. It's very expansive, I think, in the obligations, particularly with respect to incident reporting and disclosures. I mean, I think the way it's proposed, you'd have to disclose almost incident by incident basis, which could be quite burdensome. So given all this in our comment letters, you know, what's your, if you could read the tea leaves for us, you know, what's your best sort of guess in terms of where the SEC will land on this, particularly as it relates to our comments?
Well, I do think it's very likely that the SEC will adopt rules requiring some kind of reporting to the SEC and Form ADV disclosure, as well as certain policies and procedures. The specifics, such as how long you'll have before you have to submit a report, remains to be seen. But whatever rule gets adopted, I think advisors will have to revisit their cyber programs to match them up to any new requirements. And we do hope that there will be a federal coordination someday instead of this patchwork of state requirements, and the IA will continue to advocate for that.
Yeah, I just wish the SEC would remember that advisors are victims of cybersecurity as well, and it's in their best interest, obviously, to have these controls. But yeah, we'll certainly keep an eye out on this proposal. Next slide. Thanks, Laura. So, Laura, you want to talk to us about some of the emerging technologies, and I think Chair Gensler's favorite topic, cryptocurrency or crypto assets?
Sure. Next slide. So yes, another exam priority for this year is emerging technology and crypto assets. This is getting at the risks associated with automated investment advice, digital engagement practices, such as the use of financial mobile apps, and increases in crypto asset trading. Exam staff will review whether advisors take into account the unique risks that these technologies may pose. Examiners will determine whether operations and controls are in place that are consistent with your disclosures, whether the appropriate standard of conduct is met, whether your advice and recommendations, including recommendations made with algorithms, are consistent with clients' investment strategies, and whether associated risks are addressed.
So Laura, before we move on to the next topic, you know, I think you mentioned digital engagement practices and algorithms. I think certainly so-called robo-advisors or digital advisors have been a big focus of the SEC in recent years. With respect to digital engagement practices, the SEC did put out a request for information on it, and the SEC and the IA did submit our views on that. And this request, although it talked a lot about digital advisors or robo-advisors and using technology to provide investment advice, there was quite a discussion and information focus on digital engagement practices. And I think a lot of it was in the sort of the broker-dealer world with some of the gamification issues that sort of popped up in recent years. But there also is clear to us that there's some concerns in the advisor space. And we actually had a meeting with the SEC staff this week, 2 meetings, where we talked about their focus in this area, and I think it is clear to us that they are working on. I think it's going to be a rulemaking, but it could also be formal guidance. But this will be an area where if you are an advisor and you're using technology to engage with your clients, so through any digital platforms, they really will be focusing on this area, and we could expect to see, I think, some rulemaking here. So we'll keep an eye out on that as well. Okay, Laura, turn it back to you. I guess we can go to the next slide.
So advisors that give advice about crypto assets can expect to be examined for whether their compliance programs consider and address risks, whether they have adequate custody arrangements, whether they have met their duty of care and understanding of products, and if they invest in mutual funds or ETFs that offer exposure to crypto assets. Exam staff will assess compliance, liquidity, and operational controls around portfolio management and market risk. And as further evidence, the SEC is placing on protecting investors in the cybersecurity and crypto asset space. Earlier this week, the SEC announced that it renamed the Division of Enforcement Cyber Unit as the Crypto Assets and Cyber Unit, which protects investors in crypto markets and from cyber threats, and is dedicating more resources to it by doubling it in size. So this unit will focus on investigating securities law violations relating to crypto asset offerings, exchanges, and lending, decentralized finance platforms, NFTs, and stablecoins. The SEC announcement highlights the importance of maintaining cybersecurity controls and disclosing cyber-related risks and incidents.
So Laura, before we move on, I guess we do have a member question here that I want to tee up for you. But I noticed that in the Form PF proposal that Monique talked about, they did propose a definition of digital assets. I thought that was kind of an odd place to put it. What can you tell us about that definition? Is it something we can be happy with?
Well, we were pretty surprised to see them propose a definition of digital assets in the Form PF proposal. It would be defined extremely broadly to mean an asset that is issued and or transferred using distributed ledger or blockchain technology, including but not limited to virtual currencies, coins, and tokens. We said we strongly believe that the SEC should not define digital assets in that proposal. At the very least, the SEC should coordinate with other agencies and issue a separate request for public input on this definition and provide an opportunity for everyone to weigh in.
So Laura, we did get a question. You talked about sort of BCPs, and of course that's been a focus of the SEC for several years now, but they added a little twist to it. I think they talked about sort of the effect of climate change, right? And how you sort of should continue to monitor that. And we have a question here, sort of at what level of detail should advisors be sort of describing the effect of climate change? I mean, should they list out specific types of things like hurricanes, raising water levels? What can you sort of share with us on that?
Priorities don't go into great detail about what they mean, but I did also find it interesting that they were so focused on climate issues when they were talking about BCPs and cyber, but maybe that's a good segue to our next topic.
Great. Right on cue, Laura. Okay, William, ESG. What's going on in this space?
You know, a lot, Sanjay. So thanks for turning it over and welcome everyone. ESG actually clocked in at number 2 in the exam priorities. You know, it was a little bit disappointing. We weren't able to take over private funds, but I thought it was still a pretty good showing. We've really known since April of 2021, when there was a risk alert on ESG and also the creation of the ESG Enforcement Task Force last year, that this would be a really urgent issue for the SEC. As Sanjay noted earlier, we've seen several ESG proposals on the SEC's rulemaking agenda, including one that is out currently for comment that's related to public company climate-related risk disclosures. Next slide, please. So
William, before you go on, I want to remind folks, if you could, we are willing to take questions, so please type them into the chat box. We'll try to answer those questions. Sorry, William, go ahead.
Yeah, no worries, absolutely. So ESG strategies and strategies that incorporate certain ESG criteria have really increased exponentially over the past few years, mostly in part to meet investor demand. So as of last year, there's more than $16 trillion in assets held by investors and investment advisors employing ESG strategies. In this environment of this increasing ESG acceptance, advisors have begun to post their ESG policies online and also deliver periodic ESG themed reports and other marketing materials to their clients. At the operational level, CCOs are now faced with discerning how best to measure and test their firm's adherence to those stated values and principles that can be both hard to qualify and quantify given the relative complexity of ESG due diligence. The exam division continues to look for what they call greenwashing and also other types of inaccurate or unverifiable statements and disclosures relating to ESG issues. Next slide, please. So there are several risk areas that we need to look at in the ESG space. I think the first one is the lack of standardization in ESG investing terminology. What's really interesting that while we have this growing popularity of ESG in the United States, there's not one single definition of what it means in practice. Many terms are used in the marketplace: ESG, socially responsible investing, SRI, green investing, impact investing, and sustainable investing. Now, it's not uncommon to find these terms used interchangeably for marketing purposes, but I would note that the terms are not necessarily substitutable. There's also a variety of approaches to ESG investing. Advisors' ESG policies can vary immensely, depending on their targeted client base, geographic and industry focus, and other factors. Early ESG investing products generally involve the use of what they call simple negative screens, basically excluding certain types of investments that investors found objectionable. For example, it could be alcohol, tobacco, firearms, etc. Over time, however, ESG investing has really developed to encompass a broad variety of strategies, from investment products utilizing those negative screens to more complex strategies that seek to fully integrate consideration of ESG factors into more traditional return maximizing and risk management-based investment strategies. I really look at it through the lens of operational and compliance risks. So for example, it's much easier to demonstrate compliance with a simple exclusionary screen than it is with integration, since you can point to a certain portfolio and show that it has certain excluded securities. However, it's a much more complex analysis when trying to substantiate a firm's ESG integration policy. There's also the failure to conduct the appropriate level of due diligence prior to engaging in new lines of business. So before choosing or deploying any ESG strategy, advisors need to carefully consider both relevant benefits and also expected costs. Next slide, please. So the SEC is really focused on whether ESG efforts are generally coordinated across behaviors of the firm and also its employees. They'll also look at whether there's controls in place to ensure the accuracy of ESG related claims and commitments included in marketing content, financial reporting, portfolio management and proxy voting policies, verbal and written employee public statements, and this does include social media where a lot of these statements can be found, Form ADV disclosures, and also other SEC filings. These considerations may apply not only where an investment advisor adopts an ESG policy, but also if a single client engages the advisor to manage an ESG strategy. I'm going to discuss each one of these topics in the context of your compliance program. Next slide, please. So in order to manage examination risk, firms should really evaluate their ESG strategy holistically. And that's supported by a strong governance process that includes consistent use of ESG terminology, formalized policies and procedures, marketing reviews, and also a testing process. Next slide, please. First, let's look at portfolio management and proxy voting. Now, there's a handful of questions you should be asking yourself related to this topic. The first question to ask is, do you have controls in place to evaluate whether ESG disclosures and marketing are consistent with your investment decisions and proxy voting practices? Advisors that have adopted ESG policies should have in place a framework for measuring how those investment and proxy voting policies and activities comply with both the firm level and account level ESG policies. Do these controls also evaluate public communications in compliance with voluntary standards? For example, adherence to global ESG frameworks. If you're a signatory to the UN's Principles for Responsible Investment, the UNPRI. So signatories to the UNPRI or other published ESG frameworks should ensure that their ESG policies and practices match the representation the advisor has provided to investors of their commitment to those standards. Also, when relying on goals established either under national or global ESG frameworks, provide clear and prominent disclosures regarding how investments are evaluated under such frameworks. So that could be a net zero commitment or some other commitment that's publicly made by a firm to its investors and shareholders. You'll also want to ensure that your Form ADV disclosure accurately addresses ESG investment and proxy voting practices and is consistent with other public documents and communications. The next question is, how does your portfolio management team memorialize consideration of ESG factors in the investment process? You'll want to review what specific documentation is required at various stages of the investment process. That could be research, due diligence, or the selection and monitoring process. And this can result in contemporaneous documentation of ESG factors that are considered in specific investment decisions, which is something the SEC is going to want to see. You should also review and ensure that there's a process for how portfolio management teams substantiate the potential economic impact of ESG factors on the portfolio. Also, do you have controls to define, monitor, and update client ESG guidelines? So for example, this includes taking affirmative steps to ensure clients' ESG directives and investment preferences and prohibitions are not only met initially, but they're also updated appropriately based on the needs of the client. And again, you'll also have to have written policies and procedures to address each one of these issues. Next slide, please. So let's now move to marketing and communications. And this kind of dovetails really well into, I know a lot of firms right now are preparing for the implementation of the marketing rule in November. But specific to ESG, how are you reviewing and substantiating marketing claims related to ESG? So we really expect advisors to face questions from exam staff and need to substantiate qualitative and descriptive statements touting an advisor's comparative advantage or expertise in the ESG area. Firms that reference ESG in their marketing materials should be prepared for exam staff to scrutinize whether these ESG related processes actually align with the public-facing ESG-related statements they're making. Compliance personnel should also review data supporting ESG performance metrics included in marketing materials. And this is really with an eye towards adequate disclosure of the potentially different risk-return profiles of ESG investments relative to other investment types. Also, do you differentiate environmental, social, and governance risk factors? So do you have a separate risk analysis for each type of factor? For example, environmental risks created by business activities that may have negative impacts on air, land, water, or health. Social risk can refer to the impact that companies have on society, and governance risks concern the way companies are run. So again, those are very different risks when separated out. Also, are you clearly and consistently defining ESG terminology? And I've already stated previously, there is no commonly accepted definition for ESG. But do you define what ESG means for purposes of your investment objectives of particular funds and strategies? So I know some firms have actually created an internal taxonomy for ESG issues. But again, if you do define ESG terms, please make sure that they're consistent throughout all of your documents. Now, one thing I'll note is that the recent public company climate-related risk disclosure proposal that's out right now should really help provide some of that consistency, at least with the environmental terms, because they do provide a lot of definition around climate-related financial risks and other definitions as well. So I think that should be really helpful for investment advisors down the line, because they're going to be using those types of terminology. So also, do you have policies and procedures to address the use of third-party ratings? You know, with the currently wide and sometimes unfortunately inconsistent ratings related to ESG, you'll definitely want to substantiate how and why you're using the ratings you selected. Next slide, please. So let's go to compliance programs. So compliance measurement in the ESG context really differs from traditional compliance testing, primarily to the subject matter involved. ESG policies can be more nuanced and can relate to some of society's most firmly held, but also politically sensitive beliefs. You really need to look at how you're integrating ESG into your compliance program and risk management processes. Again, while compliance measurement does differ, you should really integrate it with your existing methodology. I don't suggest you try and reinvent the wheel from a process perspective. A few examples of this: ESG-related reputational and other risks should be successfully identified. ESG compliance failures should be identified, addressed, and disclosed. Employees, very important, should be given clear and appropriately detailed guidance on complying with the firm's ESG policies. And also, ESG compliance should be part of the CCO's annual compliance review, especially when the advisor is using ESG in a firm's branding or other marketing efforts. And the last thing I'll note is that, while it's not required by any specific rule, I think there really is a need for compliance staff to really understand a firm's ESG strategy. So one interesting note from an April 2021 SEC risk alert that I mentioned earlier was that one of the deficiencies that was noted was the compliance staff's lack of expertise with ESG issues. So you should ensure compliance personnel have the experience, competencies, and knowledge required to adequately conduct ESG analysis and oversight functions. And again, compliance personnel should also have a seat at the table for the investment advisor's ESG strategy. I think historically, ESG has really been housed in the investment and operations departments. But I think with active participation with those departments, compliance personnel can really obtain the expected level of knowledge of an advisor's specific ESG related practices.
So thanks, William. We did get one question. What should advisors consider or implement if they're using an outside manager to offer ESG strategy to clients versus doing it in-house?
Yeah, absolutely. And that's a good question. It should be a lot of the same processes you're already taking with third-party managers, but you'll definitely want to make sure that they are implementing the ESG strategy that you've hired them to do. So, I think that's a really important note, is that you have to kind of look beyond their disclosures and actually look at the funds, look at the different strategies. But yeah, I think it's should be similar to the oversight you do of your other third-party managers. But again, really focus on, are they really meeting those obligations that they're disclosing to your clients?
Okay, great. So we got a bunch of questions here. I think I do want to sort of end on probably my least favorite topic, and probably a lot of folks, but it's the use of hedge clauses. Monique touched on that. And I'm actually going to put Gail on the spot here and ask her to jump in and field this one. And then the question is, what is the staff really focused on here? Are they focused on misleading hedge clauses, or just the staff just doesn't like them altogether and we should take them out? And the questioner referenced a webinar call that we did on this. So Gail, do you want to maybe just tee up answer this question?
Sure. Thank you for giving me the softball, Sanjay. This is a really actually a difficult question and a complicated issue. And we have had one member call on it. We're planning on having another, so stay tuned. This is a developing issue at the SEC. It kind of started with the interpretation, the fiduciary interpretation, that in a footnote suggested that hedge clauses, limitations of liability in the context of retail agreements would virtually never be acceptable, and there'd be more leeway in the context of institutional contracts. As time has passed since then, the SEC seems to be more and more skeptical of any kind of limitation of liability clauses. And even though the enforcement action, I think there's one specifically that the SEC board really does have bad facts. It was a recidivist advisor. And there were changes to the limitation of liability clauses, but the focus has been, I think, less on misleading and more on confusing, that clients may not understand exactly what the hedge clause is trying to do. So that's a kind of a long way of saying that any agreements that have hedge clauses in them are going to be subject to possibly being looked at by examination staff. I think that the hedge clauses were basically proposed to be prohibited in the private fund advisor proposal that Monique talked about. And there's been a lot of pushback against the SEC on that part of the proposal. So I do think that it's in flux, and I think we're going to get some clarification from the SEC about what it means. And what it means to want to prohibit versus, what's misleading, what's not misleading, what's confusing. I'm hoping that we get some clarification. But in the meantime, I would say that if you have them in your agreements, you should really take a look and you could well be examined for them. It is sort of worth pushing back on exam staff if they are not misleading and if it's very clear that you're not trying to waive the fiduciary, the federal fiduciary duty, and that you're not trying to impose, a standard that's higher. But you have to take a look at that.
Thanks, Gail. So unfortunately, we're out of time. We had a few more questions, and as Gail noted, you always have access to the IAA Legal Team. The numbers, we have our email address at the end of the slides. Next slide. And I just want to remind you that we do have a lot of resources. I think key among them are the various committees and working groups and forums that we have, including implementation groups. So if you'd like to get more involved in those, just let us know. Next slide. And here's the email address and the telephone number. So if you have questions that we didn't get to, please do reach out to us. And then going forward, any questions that you have, we'd be happy to try to help you. So next slide. Thank you for joining us today on this webinar. We hope you found it helpful and enjoy the rest of your day. Thank you.